All right. We are live, I do believe. Just some quick diagnostics. See if we can get this new camera setup working. Make sure we are good to go. All right, let's see here. Doing okay, maybe a little bit more that way. See if that works for us. New camera setup working. All right, looks like that looks okay. And we're pretty close to ready to go. Got a little change in setup for us this time. I was informed that maybe my last setup was a little bit distracting. Oh, now you can see my random art and just a few cards over there. All right, we'll try one more little adjustment. This is a super professional setup. Well, we'll get to that. Should be an interesting show today. I'm pretty excited about this. This has been fun to learn over the last few weeks, and really just generally is really kind of an exciting thing in general. I will be sharing some comments there, hopefully, and I will see if you comment down there. And with that, I think we're basically ready to get started. Today is April 11th. I've got my new iPad. Very cool. Sorry. Take two. Oh, this will all be fixed in post before we go live. Roy, this is a live show. Yeah, I know. Action. Just relax, folks. Today's April 11th, 2021. This is episode 115 of Escaping Dystopia. This is DeFi Explored. We're going to go through this from an interesting perspective, which is mine. As we learn this, if you were to start to go on to the YouTubes or the internet, you would find a great deal of information about this kind of stuff. A lot of people speaking from various levels of knowledge and information. I'll be clear where I'm coming from on this. I'm going to talk a little bit more about my background personally tonight. I don't do that a lot on the internet for obvious reasons. And then we're going to just start exploring a few things. I was actually going to do a couple things tonight, but I don't think that's going to happen because gas fees are not where I want them to be. But we'll talk about that a little bit later as well. But again, feel free, anybody who drops by, feel free to ask any questions. I should be monitoring the thing, so hopefully I'll see them. So we like to start off every show here on this Escaping Dystopia show talking a little bit about Spaceship Earth. This is explained in a previous show about what the metaphor here is about this little planet that we're on and how to use that to build a moral structure to deal with life in general. We are making some decent progress here, at least from the United States, like acknowledging that we have a kind of a climate crisis to deal with. We're going to talk a little bit about how this relates to our cryptocurrency discussion and decentralized finance in general. This comes up mainly under topic 6, talking about proof of work versus proof of stake. There's been some news articles some people write, little people understand about the energy use involved in Bitcoin or mining Bitcoin and some of these other things. And it is extensive, and there's a reason for that. I'll talk about that a little bit tonight. We're not going to go into that too much. We are going to talk a little bit about kind of the future solutions to that issue. I don't really see that as a huge detriment necessarily to using this technology. The internet itself consumes a great deal of electricity, and I think when you start to build these mining farms and things like that, one of the things that makes them worthwhile from that side is efficient energy usage. Although what they're using that energy for in this case, which is securing these financial networks, is of questionable use and of questionable need. And that's what we'll talk about a little bit later, but we'll get to those. So a little bit, before we have any long discussion about decentralized finance and cryptocurrency, why should you listen to me? Generally, you shouldn't. For the most part, I'm just doing this because I like to talk about this stuff. I'm very interested in it. This is kind of a confluence of a lifetime of experience in the professional world for me and a lot of this stuff. I know a lot of folks are actually kind of starting their careers with moving into DeFi and having a lot of this stuff just already being laid out for them. For me, it's a little bit different, right? My internet background goes back. I was an early adopter last century. It's so funny. The 1990s are now as far back as the 1960s were in the 1990s. And I remember in the 1990s how far back the 1960s were. And I've got 4 kids, by the way, and I try to explain to them sometimes what things were like before the internet. And it's not even a concept. And I remember when people thought the internet was a fad, the internet was going to go away, and it was just this stupid nothing with no use case. And that's the same place where a lot of people are about cryptocurrency now. And I see that metaphor, and I've drawn it before, but I think it's pretty clear that this isn't a fad. It's not going away. I've been following this stuff for 20 years. By profession, I'm a data engineer currently is my title. I do a lot of stuff with databases. My background is in a lot of financial stuff, bankruptcy, consulting. There's a lot of big names you would probably heard of if I was going to talk about it a little bit. You can see my shirt. If you don't know what that means, then you might understand. I'm going to talk a little bit about that later. I got this because I was in there doing stuff after they did stuff. I don't talk a lot about my professional Bona Fides or other things online just because of my propensity for political discussion that I've always been engaged in online, and mixing those two, professional and political, can be dangerous, particularly when you take it from a fighting fascism standpoint like we have with this show. So we'll see how this goes, but this is a little bit of me coming out of the shadows on some of this stuff. But yeah, so I've been doing this stuff for 20 years, digging through the databases of large financial institutions, determining how transactions were done and where balancing debits and credits and ledgers. One thing that you need to understand about blockchain technology in general is that for the most part, that's really what it's doing. It's a ledger, right? It's just keeping track of how much of one thing one entity has control of or it owns, right? So that's really all they are. And this public blockchain technology, we'll talk a little bit more about this, has really been a wildly new innovation, or just amazing innovation, but it's an innovation of a fundamental aspect of human society, which is these keeping track of who owns what, of how much. Oh yeah, so this was section 2, my bona fides. So anyway, I've been doing this for 20 years. I've been digging through this. On the cryptography side, I'm a developer as also. So when I'm looking through this stuff, I actually will go to the code and the repositories. I haven't actually built a full DApp yet, which would be one of these decentralized applications. But I'm pretty close to finishing some of them. So that's where I'm kind of at, right? I'm a programmer, developer with a financial background and a database guy. With 10, 15, 20 years on whichever one of those I want to try. So this is right up in my thing. As far as the cryptography side goes, I was back in the day, early 90s, late 90s, one of those kind of script kiddie kids, running scripts, doing stuff. Never got in too much trouble. Again, I'm not going to tell you guys too much stuff about what I've done here, there, and backwards. But yeah, I got a bit of a background in cryptography, so I do understand, a lot of hashes, all this stuff, and have for a long time. So it's been interesting to see this kind of stuff, public, private, key cryptography. By the way, anything that I say tonight, if you don't understand it, just Google that term and start reading. This is way I've gained so much knowledge over my life, is not to be scared or intimidated by terms that you don't quite understand, but to then explore them and let your kind of not knowing just be a part of your exploration, and you'll find that over time, as you continually do this, jargon starts to click a little bit more and things start to make sense. And then as you learn the same jargon across various fields, you'll start to see the overlapping ideas behind them, and things start to click and make sense in a more of a web of understanding. It's one of those things that you can't quite just get without having, like I was talking about a little bit, some of that longer term experience to see something for what it is. And so this is why I'm telling you straight up, as somebody with that kind of experience, with this lifetime of experience doing this stuff that we're talking about, this DeFi, cryptocurrency, this next level of the web, it's real. It's a real thing. It's as real as the internet, right? And the numbers on the screen as they change, they're real. It's real money. The discussion of a lot of this stuff goes into the fundamental nature of what money is and how people use money and what's the point of it. What we're talking about. Okay, you can still hear me. So that's one of the things that's fundamental to this on that side as well, right? And so I'm going to share this on my page in case anybody wants to come on over. So that goes into this fundamental nature of this store of value, right? This increment of account, right? The nature of money is very much a part of this. So I hope people don't forget that that's kind of fundamental to this. And when we're talking about this changing nature of money and how it's exchanged and representative, we need to remind ourselves that whole time that this value proposition that it represents is a social construct. So this is not, there's no inherent outside of human perception and human feeling and human belief that a lot of this, any money has value. And so this stuff is real. It's real as rain. All right. So those are my bona fides, right? People pay me too much money to do all this stuff. It's real. It's just, it is what it is. Come on over. Let's try that. All right. So, it's real. I know what I'm talking about. What are we talking about tonight? Well, here's one of the things too. And there's a phrase that comes up all the time on the internet and in this community of folks doing this stuff. It's called do your own research. Now, this is dangerous nowadays on the internet, right? When you go type in the internet, blah, 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 there are a number of entities, and can be, that want to step in between you and that query and give you information that is perhaps not as objective as you would have liked. And by the way, remember that little construct where these robots step in between you and what you're trying to do and give you something that's not quite exactly what you asked for before you get the thing you do ask for. Because that will come up again. But anyway, you need to do your own research on a lot of this stuff. That's why I'm saying look up these terms, follow it. There's a wonderful, let me go ahead and link it again, the MIT class. This is making the rounds again. There's an MIT cryptocurrency class. It's taught by the guy who's going to be currently the Secretary of the Treasury, I think. I'm not going to go too much into that, but anyway, you can, is this it? I thought there was just, sorry. There we go. I'll link to it. There we go. MIT OpenCourseWare. Here we go. Anyway, this is a good thing. So I just want to say, look, the only thing that's standing in between you and understanding this is sitting around and watching this instead of another sitcom, right? And this will give you a lot of this stuff at a high level, but still pretty good. Also, read a lot. I mean, there's good information out there. There's bad information out there. You're not going to know which is which until you have some context for that. So if you're interested in doing this kind of stuff, find some good people to stick with and read them. I'm not going to give you a list of things right now. I would say generally almost always go to the project website. Go check out their thing. They have tweeters. They have Discords, they've got telegraphs, they've got Reddit pages. You know, all of these projects exist. Again, they're real. This stuff, you can't act like it's immutable and in a different world, because it's not. It's in this world. We're all tied together. So as you look at these projects and all these different coins and the way people are using the blockchain technology, and by the way, it's mind-blowing what's out there right now, guys. But read and go check it out and see and visit their GitHub page. The jargon matters, and you're going to have to learn what it is and how people are talking about it. We'll talk about a few things later as well. Swap pools, liquidity farming. These are terms you'll hear that, maybe you've heard them before, or they've been used in another context, and I find that a lot with you have different domains that will use the same word in a slightly different way with a slightly different subtext or context. And so that jargon matters. This jargon is pretty fun. And if you want to be blown away quick, let me just show you this. I'll show you, this is the InstaDApp. And I'll link it, and you can go and look at it, and you can click around a little bit. And I would say very quickly, if you go from the dashboard, I'll link the dashboard. I'll just put that. And you'll go, what the heck is going on? And the thing about that is because you don't know what's going on. But if you click on a few buttons, all of a sudden you can make this thing come alive with your entire portfolio. And it'll show your entire net worth and your total worth, how much you've borrowed, how much you're leveraging, how much you are staking, and your positions in various pools, all through basically can be 2 clicks. Because one of the things that's actually tied into this, and I was going to, we're good. Let's move on. We're moving on to I'm going to talk about this a little bit, but one of the things you do on this InstaDApp, and if you look at their development code, the code, literally, when you're writing what you want to do, the function that you call is you cast spell. And that spell goes out, and it goes and does this, and then it does that, and then it creates this. And these things are, say, deposit this money here, leverage it to borrow it there, swap it into this coin here, place them there in this pool there, and then all of those get lined up, and that's literally the terminology being used. Casting spells is a new terminology. But all these other things, providing liquidity to a pool, these are existing terms. So as you start to learn some of these things and see it, it's very fun and interesting. You'll see that these interfaces, I'll throw the InstaDApp one on there. There's another, the 1 inch, as well as another new one. And they've got some really incredible, engaging, nicely put together interfaces. A lot of these are very, very, very nice. There's another one that you'll see later. I'll throw up here. And these are kind of where this stuff happens. How it happens is really interesting too, because there's this other thing, and we're into section 4 now, talking about the code. And before we get too far into the code, I do want to make a point. And this is a point that I've been talking about for a long time, and I'm going to take a little bit of a victory lap on predicting the future for my whole life, and now we're living in that future. And that future was defined by the year 2020. And I mentioned this in previous shows. I've mentioned this for years in writing and all that. 2020 was the year that we kind of crossed over into a new age of humanity, the true beginning of the Anthropocene, the post-singularity world. The singularity being this idea that now computers have the ability to think and act basically like humans do. And you interact now probably, and not even really think about it too much, with bots and AI on a level that's constant, right? If you're using your voice to text and things like that, it's very, very common now in this part of the 21st century to constantly interact with AIs, and they, in fact, run a lot of the world. They're written in computer code, and this is the post-singularity world that everybody has access to human-level computing power, brain power, trivially, right? And so that's the world we live in. Now, it also happened that in 2020 we had this pandemic that shut down most of society around the world. So you have a really stark line that everyone's going to remember. And I'll talk about this a lot. But now we're in this post-singularity world where code is law. And these computer codes that are running the world are what we're talking about here. So one of the things that's very cool here is this Web3 platform and these ways to identify and connect yourself to this world of decentralized finance. One of the things that if you're going to want to do this, one of the things that you will want to set up is MetaMask. And I'll link this one as well. And what this is a crypto wallet and gateway to blockchain apps. So I mentioned wallets. You're going to have lots of wallets. As you do this kind of stuff and get into it, write down your stuff. You're not going to remember anything. I was going to mention this. I'll mention this on the side real quick. A lot of times you'll create these and it will show you a list of words. And you're wondering, why is it showing me this list of words, these mnemonics? And that's because this is how it's generating and regenerating your address and your password. It's actually just a really long password, right? And these things are 12, 18, 24 words, and they're just common words, but that's a lot of characters. Nobody's going to guess this. This is why. Because a lot of this stuff is built to resist quantum level encryption. I'm not going to really talk about that. But anyway, so remember your mnemonics. Write them down on pieces of paper. Make copies of those pieces of paper. Put them in a safe. These are your keys. These are how you regenerate your keys to access your stuff. This is your identity, is your mnemonics. And this is one of the things that's really interesting about how this works now, because once you have these set up and you have the encrypted public key of it, what it allows this to do is these websites, they'll just show you a QR code. You can scan it with your phone or your iPad. It then connects to your wallet, and then boom, everything comes alive. It knows that you have that access. You've got this two-factor authentication. Immediately you have, full encryption, unless, depending on your network level, that gets into VPNs and people snooping on your Wi-Fi. You don't want to do that. Again, this is why things need to be encrypted. And so all of this kind of stuff, what's called this trustless, permissionless world opens up. Now, what does that mean? A trustless, permissionless world. So trustless is a bit of a misnomer because it's really, the trust is in the system. It's a distributed trust. I don't have to necessarily trust you to send you my crypto, right? All I have to do is trust that the network will pass it to the correct address and that, it will come back and everything will be confirmed correctly. That's where the trust is in the system. I don't have to have a trusted third party. Now, if you look at the history of humanity, basically transactions require that trusted third party to happen, right? For me to sell you and do this exchange, I give it to someone else and then they'll do that. For any extended financial and more complicated financial transactions, right? In the case of, say, like a mortgage, right? You have a bank. That's a trusted third party. You have the person who's selling you the house, and then you have the buyer, and you have both people can have a bank, right? And so there's multiple trusted third parties. In this world, there's not a need, it's trustless. There's not that need for a third party because the network is the third party. The AI, the singularity, it runs that. That's the trust. So it's a distributed trust. So it's a trustless and it's permissionless. Now, permissionless means that there is no central entity that can deny any other entity access. Right? There's no one that says you can't have an Ethereum address. There's no entity that does that. You can generate one and then you are now connected, and that's it. It's permissionless. What another word for this is public, right? You don't need permission to use public things. They're public. It's a permissionless situation. So you have this trustless, permissionless financial network, which allows any individuals or entities, and that's important here, AIs, remember, AIs are a big part of this whole thing. It allows any entity to participate once they're given the permission and the explicit permission to do whatever. And because you have that constant chain of permissions in that immutable blockchain, it works. It works really well. And it's all in the code. Now this brings us to section 5, which is smart contracts. Smart contracts are where the magic happens. Let me go ahead and give a quick Google for you to save you 2 seconds. Here, there you go. Smart contract is a self-executing contract with the terms of the agreement between the buyer and the seller being directly written into the lines of code. So again, this is that third party. The trust is the system. The code is the contract. So, I know this is a little abstract, but what this means is lots of stuff are possible now, because this is where Ethereum is different, and other blockchain networks are very different from Bitcoin. Bitcoin is kind of a dumb network. It has the ability, there is a scripting language in it, and there's the ability for it to do some stuff, but generally it's just a single asset. It's just it's a finite asset, right? There's only going to be 21 and a half or something like that, and you can roast me for not knowing the exact number, whatever. Bitcoin's eventually mined, and then people will exchange those. Ethereum and other cryptocurrencies are very, very different from that. And before you think there's not any space for that, think of all the different things currently we have that are stores of value, from gold and other precious metals to all the either other currencies that we currently have. So don't let that be like the idea that there can only be one cryptocurrency that will ultimately win and all that. There will most likely, for my entire lifetime, be many, many blockchains continuing to run. It's an effective technology, and it can be done efficiently. And this is one of the things that people are learning as we continue to iterate over time on what's going on. So what do smart contracts allow, and what do they do? So essentially what you have in the Ethereum and other code-capable, essentially Turing-complete blockchains. I know, right? It basically means you can write code that executes. You can say, hey, do this when that, and then that if that. And I mean, this is code, right? You can write all of this. And I'm actually still learning personally how to write some contracts, smart contracts. This would be, I am the kind of person who would either audit them ultimately if I actually learn these skills. This is kind of my professional skill set. I haven't, by the way, I'm not here to audit your smart contract, but in about 2 or 3 years, that's probably where I'll be. And because, having that, oh, you can code, finance, this, well, guess what? Oh, cool. Super cool. Because then you'll be not debugging code only, but debugging a smart contract, right? So it's you're debugging financial code. And there are potentially codes in here. So what does this kind of code do, right? What does it say? Well, so you can write, if you have this many of these kind of things, then you get this many more of these kind of things if people do certain things. One of the things that's popped up really quickly over the last few years are swap pools. So somebody writes a contract, it gets deployed to the Ethereum blockchain, it has an address, right? So that now is an entity that other people can give permission and access to do things to do, and it can do other stuff. So you set up, again, these are all codes that are deployed to the blockchain. So you have a swap pool. So you now have a contract out there that says, hey, if you have this kind of coin and this kind of coin, we're going to put them in this bucket, and then if somebody wants to trade this kind of coin for that kind of coin, we'll use your bucket to facilitate that exchange. They'll both get what they want, and you'll get a little bit for facilitating that change. And that's written into the contract itself. The code is then deployed to what's called the Ethereum virtual machine, and then it runs, and it's just out there doing that. If you do this, then that happens. The same kind of thing happens now with other things, where you can, and this is how they've written the stablecoin contracts, which say, regardless of the price of other assets, this particular token is going to always be worth the same amount as this particular, real world entity. The stablecoins have been a very interesting play lately because of the way the contracts are written. They're very highly over collateralized, which means for each one stablecoin that exists, I believe it's something like $1.6 of Ethereum is held in reserve, which is interesting when the price of Ethereum is going up so much. This stuff is wildly dynamic lately, and we'll talk a little bit more about that in a bit. But these smart contracts allow for a lot of the aspects of financial systems to exist. And one of the things, like, this is where the trading comes in. One of the things that's interesting, a little bit different about this kind of stuff versus, say, a stock market trading platform, is you have direct connections, right? So you don't, in a stock trading platform, you would go, well, I'm going to sell this stock for those dollars, and then I'm going to use those dollars to buy this other stock. But with decentralized exchanges, you have the ability to just say, I'm going to trade AT&T for Microsoft, and then the ratio between of them, of the two, is then related to that third value, right? So you're not going through the dollar to trade the ownership of those two other entities. Smart contracts allow for staking as well, and we'll talk a little bit more about staking because this is part of the other. This is actually our next big section. But staking allows you to say, I'm going to lock up this value over a certain period of time, and because of the stability that provides both to the price and to the network, I'm going to receive additional amounts of that particular coin. And this is written into the code itself. So what you do is say, here, this code has the ability to run. It now has the ability to run with this much ether. And we're going to talk about gas fees here in a little bit, because there is a big downside to all of this stuff, and an answer to it. But so you can do staking with these smart contracts. What else can you do? Voting. Now this is one of the really, really wildly interesting aspects of this, because people have for a long time talked about the notion of voting using the internet and online. And even now, you've heard, this was one of the things early on people talked about as blockchain being a potential for. But now you're really, really seeing this happen. And I'll talk about some of the stuff that I've done, but I've actually participated. I've done this a number of times now, where I've been able to vote on governance issues for coins or tokens. Tokens, coins, I kind of use both terms pretty interchangeably. But you get to vote on what's going to happen next and there's a lot of these are community projects, so the community is going to vote on spending some of the community funds or making particular partnerships, or in some of these you can change the interest rates. That 1 inch, I believe I linked to there, you get to vote on all of the governance platforms of the smart contracts themselves. So you can write into the smart contract that says, okay, this contract has these parameters. We can vote to change those parameters based on how many people own what percentage of the total pool in the contract, the total value of the contract. You can also write them the other way, that says if you have any particular threshold of value staked in a particular place, you then get a voting share, a voting right. This is what's wildly interesting to me as a way to start to think about what could be a blockchain voting system. Like each one, say on this, you have a vote token, and that is what you get to go. And then for each particular vote, right, you have this token, it's attached to your name. And then when there's a vote, that's a new smart contract, each new vote would be a smart contract. You then get to go and then stake or place that code, or, basically set up a transaction that says this contract has my permission and my vote is yes. And that's how you do. And this is the thing about the way blockchain technology works, is because the blockchain transactions, once they are created and mined and essentially written into the blockchain. So the way this works, real quick, I would definitely go and look to, I'm not going to try and explain to you exactly how blockchain stuff works, but each chain of transactions is tied to the previous chain by cryptographic methods, right? You can't go back and change any transaction in the block without breaking the chain to the next one. And that's why it works. That's kind of the whole thing. It's a way to roll up these transactions, keep them live, and know that they are correct. Now, how you validate them is where we're going to get into this next part. And this is what's really interesting. So, going pretty good so far. This is fun. Like I said, got a lot of this I need to get out of the head so we can move on. All right, proof of work versus proof of stake. So, Bitcoin, when it first came out, had an idea for how to solve this problem, this stateless, permissionless, or excuse me, where are my words? Ooh, did I put them all the way up there? This permissionless public ledger network, right? Satoshi Nakamoto came up with this, the Bitcoin idea. The way that he secured it was through this proof of work algorithm. And essentially what you do is you take these transaction hash, you take these three numbers with another random number, you throw them through this algorithm, a hash, and it comes up with an answer. You have to have the answer in a certain form. So most hashes, if you ever see, they look like completely random digits, and that's kind of the point of it. They're a way to hide the data and then unencrypt it later if you need to. There's some one-way hashes and there's some two-way hashes. Sometimes you can go to the way where you're going to, hide a password or something, but then you have to unencrypt it. So you have to be able to go both ways. In the case of Bitcoin, this hash is a one-way hash. You're only going to throw a bunch of stuff basically in here. You're going to bake the pot, and then it's one way you come up with your random number. That random number has to have certain characteristics in order to create the next block. And what those characteristics are, it has to have a certain number of leading zeros. The way that they do, and this is what's really interesting about the whole mining and how you build consistency in these networks, by controlling the difficulty of generating that random number to mine the next block. And if there's a whole bunch of computers doing it at the same time, you make it really hard, and then you end up with a consistent time period of blocks. For Bitcoin, I think it's like 10, 14 minutes, something like that. And then every 2 weeks it says, oh, this many blocks were created, we need to make it harder, we need to make it easier. I think right now it's at a current high of something like, I think it was like, so this is why it's so difficult. This is the energy reserves for proof of work algorithms. I think it's a 64 character hash result, right? And of those 64 characters, 26 of them have to be zeros. So what you do is you take the previous one, you take another thing, and then you mix that with a random number. And then you get this 64-bit long random character string. That random character string needs to have 26 leading zeros in order for you to create another block. Now, the difficulty of this is huge. It's astronomical. When you're talking about like gigahashes and petahashes and all sorts of other like Latin roots, like billion, trillion, like 15 zeros of operations. To give you an idea, I fired up my computer. I wanted to, because Ethereum right now is at an all-time high. Gas fees are ridiculous. And so I was curious how profitable mining could be right now for Ethereum. And so I fired up my miner. It's not hard to do, folks. The SHA 256 algorithm is known. It's public. You can read it. You can do it on paper. It's not fast, but you can. Right, and as you look through the code, you'll see how it works, how it flips the bits, and how it, but you can do it. Like my computer is, I think it's like 27 to 30, depending on stuff, mega hashes a second. So that's million hashes per second. So what it does is every second, it creates 27 million guesses, right, at this thing. And that's all it's trying to do is get random numbers with the right characteristics. That's what mining is right now. And so what happens when you guess that right number is you then get the right to create the next block. So what you do is you go out, there's this pool of existing transactions that people would like to be added to the blockchain. You look at all those, you bring them into the block, you mine the block, which is you use your special key, you create the new one, you pass it out to everyone else. They look at it, they can see your answer was correct, it works, move on to the next one. They grab a whole pool, boom, boom, boom. That's how you do it. That's the blockchain technology. Proof of work requires that you find this answer. And there's the word, it's called a nonce, is the number that you're picking. It's one of those weird words that you haven't seen anywhere else probably. But that's the one that's added, is the nonce. The end result is the hash. So you're guessing all these nonces. This just takes energy. It just takes power. And the way they do it, and this is where all these machines that are built, these ASICs as they call them, which are just, and they're really simple. That's the thing that's about it, because all you're doing is arithmetic. It's just math, basic math. You're just doing it a lot and very fast. And that consumes electricity. That makes the computers hot. Fans consume electricity. That makes the computers cool. Electricity costs money. They're making money. There's balance. If you can get free electricity by stealing it from the hydro dam, you can make lots of money. So that's where a lot of the stuff happens in China. And we'll talk a little bit about this, about the 71% attack, 51% attack. Let me see if I have this bookmarked real quick. I think I had it here the other day. Is that it? Nope. Sorry. Should have looked this up before. There it is. Cambridge Bitcoin mining map. Anyway, so with proof of work, the ability to do hashing gives you kind of control of the network, because if you have the hashes, you control what goes into where is that number? The Cambridge Bitcoin Electricity Consumption Index. This is a thing that's out there. But what this shows you is that 71% of the energy currently being consumed to create new Bitcoins is happening in China. And this is something I've talked about a little bit, and will be a much more interesting thing moving forward. This is the future of currency, and China is dominating it right now, to say at the least. Because of that free energy and free electricity and the industrial base that they have right now. And that was, the 71% was one of the last things. So there's this concept, I don't think I'm going to go into it too much, but the 51% attack is an idea if more than half of your validation network is using bad transactions, if it just is making or modifying transactions or doing other things, then they can kind of they can mine a block, then mine another block, and mine another block. And if they can do that faster than the good chain can do it, it ends up creating a fork in the chain. And that's the idea is that people are scared of, is that you could have a larger portion of the network decide to do something malicious against the network and either do false transactions or double spend, where you spend a token once to get some exchange, but then you keep it and then you spend it again. These kind of things, of course, destroy the ledger. There's been a number of forks for Bitcoin and also Ethereum, and that's exactly what happens. They are literally forks of the chain, of the blockchain. All right, so I think we've talked a little bit about some more of this, and oh yeah. So one of the things that's really fun about this decentralized finance, and what you can actually do now, because it all is just there, right, is these kind of swap pools and liquidity pools. The liquidity pool is a really interesting idea, and a swap pool. So, for those who don't know, and my apologies if I'm just explaining something that's very basic here, liquidity in this sense or any other sense is the ability to change an asset into something else, really. And I think of it like, I always use physics as my metaphysics, right? The ice has lower liquidity than water, and water has lower liquidity than gas, right? The ability to change the thing into another form quickly and easily. How quickly can I change this into that and change that into this? Liquidity in crypto is a little bit different than in traditional finance and in decentralized finance, because again, like I was saying, in traditional centralized finance, liquidity is all about the dollar, right? And being able to move it into cash. Generally, I mean, that's the biggest thing. I'm sure people can correct me all the time. Please feel free. And here, liquidity is the ability to move those tokens easily or quickly, right? The same kind of thing. What the liquidity pools allow, and again, these are smart contracts built on this same foundation, is to say, hey, again, you would like to change this into that. I can help you. And I have these locked up under my control. I'm a smart contract. And I will make this market happen. They happen through these things called automatic market makers. In a traditional exchange, you're going to have people doing the same kind of thing. You have a spread. What is the difference between what people want to pay and what people want to sell at. And they can get really close, but they don't really cross over very much, because once they cross over, it's very easy for people, oh, definitely, boom, boom, boom. So they tend to get close, but not touch. And so setting the price for these kind of things is a very fundamental aspect to an exchange, right? That's the whole idea of allowing the value to have the liquidity to flow to where it is needed or wanted most. And that's the whole idea behind this money thing, and the idea of exchanges and the value of having stock markets and this kind of stuff. So this is those aspects of a financial system built on the notion of value, and then exchanging that value, moving to, and now we're talking about providing utility to others by locking your value in a certain place. And again, this is all done with smart contracts. How do you tell it to do smart contracts? Gas. And this is where anybody knows what the heck's been going on for a little while. It's just like, yeah, gas fees. So gas fees have to do with the way that Ethereum is written and the way that the network works. And the idea is that each one of these smart contracts has a certain amount of work that has to be done in order to happen, right? So if you're saying, if this, then that, do this, that's a certain amount of work that has to happen, whenever this thing happens. And that takes work, right? So then it costs more. Those are the gas fees. So when you set up a smart contract that's really complicated, that's saying, oh, take this, then that, if this, then that, or these, take these three things, switch them over, gas fees can get really high. And so what you have now, and there's a lot of good stuff on this, and there's a Gas Now page. I'll show you so you can just look and check it out and see what I'm talking about. Gas is paid in GWEI. I don't know how to say that word. GWEI. Which is a small denomination of Ethereum. Currently, the GWEI price is 66, which is about $3. This is actually the lowest I've seen this in a while. It's Sunday afternoon, Sunday evening. This is generally the lowest price for gas during the week. Has been during this whole bull run. So if you are planning to set up any of this kind of stuff, this is the day and time to do it, this evening probably. So why is that? Well, because what you're trying to do is make the network do stuff. So you're throwing transactions out there in the memory pool, and there's people working on them, but they have a choice about what they want to do. And this has been the thing that's happened now. Because of their ability to pick and choose which transactions to complete, it's started to really kick up the gas fees. So if you don't pick a high enough gas fee for your transaction, it's not going to be pulled out of the memory pool and mined for some amount of time. That causes another problem. So this is what's wild about this, because as you continue to move in, you see this next thing. Let me tell you real quick. So this is all the stuff that what kind of has to happen for these smart contracts, right? So you'll go through a DApp, and then you'll give it permission to use the coin. That's a gas fee, transaction fee. Then you'll give it, say, permission to use another coin. Gas fee, transaction fee. Then you'll create those swap coins. Right? This is a process on 1 inch. Gas fee, transaction. And then the big one is generally when you when you put those, I say try, because a lot of this stuff is so just basic now. You don't really know what it's going to cost to do these things. So then your final big transaction is you're saying, oh, put this thing into this. Put these pairs into this pool. What that does is it activates that smart contract that also says anytime anybody uses that pool, I get a certain amount of those fees. Now, this is how straightforward it is, and this is what's really interesting about it, is you can see all of this stuff happening. And it's all directly in front of you. So let me give you a quick example, right? So say there is a swap pool, and the total amount in the pool is, say, $100,000, right? And your percentage of the pool is 10%, right? So you have put $10,000 into this $100,000 pool. Now, any of the money that exchanges that goes through that pool, right? This is the, talking too much, the volume, right? So you have this pool of 100,000, and say in a day 500,000 is exchanged through it from one of those coins to the other, right? So of that $500,000, there are fees of roughly 1/3%. This is the Uniswap, what they have, which is by far the most popular one currently. So of those 500,000, right, you have fees of 0.3%, which would be like 2.5 or 2,000, something like that. Those fees get distributed to that the owners of the pool, right? So there was $100,000 in the pool. You had 10,000, so you got 1/10 of the pool size. There's $2,000 worth of fees that were generated by that $500,000 worth of trading. So now you get 10% of the 2,000. You get $200 distributed as the swap pairs. So you are providing liquidity, you're providing utility, right, to the market to facilitate the transfer of value. And because you were doing that, you get the rewards. And now I say you. Who is you? Anybody. That's the whole thing. It's permissionless and trustless. Anybody can do this, or anything. And this is what's gotten really interesting now. Because of the high gas fees, there are situations where people are trying to, or it's happening all the time, because I actually see it, and it's actually on the miner's website when they talk about it. So if you're trying to do a trade to create this value opportunity, and it sees in this memory pool, in these waiting transactions, a transaction where there is a particular large amount of slippage and a particularly low gas fee, or a situation where it can just step in, and this is the value differentiator, the bots can see this and step in front, grab this value, and so they know that you want to do this. They're going to step in here and take that chunk out of your trade before it even happens. Now this happens because of the way, this is a huge, network effect that ultimately happens. Hold on, oh shoot. Sorry, cat. This is a huge network effect that happens as a result of all these other things that are going on. So, as I was mentioning the mining stuff, right, it actually highlights this on the webpage, saying that we are now setting up to keep an eye out for these types of transactions. They call them, what is it, MEV? Let me see if I can find it, because this is really fun. And they actually look up now. Let me make sure I can read this to you. Where is it? This is on their Ethereum page. But anyway, they actually look out for these transactions, and they get bonus points for mining them. There it is, plus MEV, the block rewards. And they show you exactly how to do this. It's very, very simple. And then, let me see if I can... is this what I wanted to see? There it is. What is MEV? This is what I was looking for. MEV stands for Miner Extracted Value. There you go. Ethereum mining pool could get extra profits by including some special arbitrage transactions in the blocks. Arbitrage transactions are those where people are trying to trade on the different values of the same product in different sources. This is an automated process that is possible thanks to P2P exchange platforms, DeFi, which is, again, P2P is people directly exchanging with no trusted third party. When the fund swap is done without a centralized exchange. So, let me read that again. This is an automated process that is possible thanks to P2P exchange platforms when the fund swap is done without a centralized exchange. Specialized software can watch the incoming transactions in the blocks to seek opportunities to step in the middle of a chain of of token exchanges and profit from the different exchange rate. So MEV transactions are already being included in our pool blocks, bringing increased rewards to miners. So that's one of the things that's happening, which is, to me, just wildly interesting that can happen. And how it happens is because of the nature of the system and because of this proof of work algorithm that you're trying to do. We actually are already in the risks section. So I was talking about the gas fees too, and I wanted to cover something real quick. If you see on the gas fees, you can see right now, like Maker, DYOR, Borrow, the rest, the FAPID's $27 to make that happen. Tornado Cash deposit is $131 to make that happen. Tornado Cash is an anonymizing smart contract. So it actually will break the chain of what is doing what. And because the high cost of doing that programmatically, you have very high gas fees. For Uniswap, it's like swap Ethereum and USDT, $21 for those. OpenSea registry, $64. That OpenSea registry, perhaps you've heard of the NFT thing that's been happening, non-fungible tokens. The idea of owning gifts and little other things. The fee there that I just mentioned, that gas fee, is what you have to pay to take possession of it, to tell the blockchain, hey, my address is now the owner of this particular NFT. To mine that transaction, the gas fee is very high. It's $60. So if you're buying any NFT that's not worth $60, or a $60 delivery charge makes your investment immaterial, it's not a good buy. And this is one of the things that I really need to talk about and make it very clear. And that's simply this. The gas fees are too damn high. They make so much of this stuff really hard and expensive to do. One of the things that's also really interesting, difficult about it is because one of the whole points of cryptocurrency from the get-go was hoping to democratize access to financial resources and to level the playing field, so to speak. One of the issues that you run here with this current system of this transaction fees and gas costs, gas fees are a fixed cost, right? So it costs. So here's the thing: you're making a change on a ledger, right? So you're saying this person has this many of this thing. If that number right there is 10, or if that number is 10 billion, there's no difference in the cost to the ledger, right? It doesn't care. It's not a million times or a billion times higher. It's the same cost. So the transaction gas fee for both of those transactions is exactly the same. So your transaction cost as a percentage of whatever transaction that you're doing goes down wildly as the overall value goes up tremendously. I'll let you out in a minute. I'm almost done. Maybe we can just do this real quick. Sorry. So gas fees are too damn high because what they're doing right now is setting up a situation where only folks with a great deal of Ethereum can do much. And anybody who's in a situation where, oops, that's not good. Oh no, we're going to have to cut that out. That's all right. You get to see some of the other stuff. But anybody who's in a situation, where they have to buy Ethereum in order to complete transactions, and Ethereum is currently running at an all-time high of cost, is in kind of a tough place, right? And so that makes it really difficult to make anything happen if you don't have any of the resource that it costs to make things happen. And so there's a bit of a locking up, right? And this is where there's not that liquidity in Ethereum needed for all these other markets to really kick it off. Damn cat. You know. You do everything and then the cat screws it up anyway. All right. I think we're about done here. This has been an interesting show. All right, bad things, man. So, some of the bad things I just talked about, right? You're dealing with bots the same kind of way that their front running can happen in traditional Wall Street transactions. You've got miners who are also, working on that other side. There's an interesting dynamic here. It's coming up in a little bit. In the crypto space, and it's the tension that exists in a lot of software and IT departments at this point. And that's the difference between developers and operations. And if you think about it like on that side, the developers are people writing the code, smart contracts, things like that. Usually kind of the flashier side. Operations is the miners. These are the people who are actually operating the network. They're two different skill sets. And that's one of the things that makes it really interesting. And they have different requirements too, right? To be a developer, to me to write code, I don't need anything more than a laptop. And I can write whatever code. To be a miner, there's a large investment in hardware, in computer hardware, in order to do that mathematical calculation I was talking about earlier. I didn't actually tell you about proof of stake, which really kills me, because proof of stake is the solution to a lot of this stuff. And Ethereum itself is moving towards a proof of stake. That's what Ethereum 2.0 is. You'll hear people talk about that. Apparently that's going to be years away. There's a change potentially coming out this summer. It's what's called EIP 1559. These are public discussions. Again, the way that the network is governed and the way that you upgrade and change Ethereum is pretty Byzantine. It's a little inside joke. But basically, you have to get a lot of these people on board, or you start to face the potential of that 51% attack of a revolt and a fork of the chain. And the potential becomes that your new fork that you want to apply this new transaction burning cost to becomes the dead fork that no one minds. I don't think that's going to happen. But these are the kind of risks that happen in this world, that exist. You have exchanges that disappear. This is one of the things that MetaMask and some of these others as the wallets are a good solution to. And generally having your own keys and your own wallets is what's recommended. The centralized exchanges, and we're going to talk about that here in a little bit, because that's happening this week. Centralized exchanges are stuff like Binance or Coinbase. Coinbase is going to go public in 3 days. It's been a private company for this whole time. I've been a member for 7-8 years, long time. I've made ridiculously stupid trades. I'm not. I'd have told you if I was cleaned up on all this. I had a bunch of Bitcoin, sold some early on in a few spikes. I've done well over the years. I've not lost money ever on this stuff. And it's been the fact that, look how much money I've made. Let's buy something nice that I've pulled out. So I haven't been a hold on for dear life person. I've been let's use this as a functional real world thing the whole time, which of course has had slightly less than awesome effects as I look back and see what I spent 1/3 of a $300 Bitcoin on. I had a credit card that was tied to my Coinbase account for a while, and I can go back and see these $32 transactions that I paid with 1/10 of a $300 Bitcoin, just to try it. So I've been spending this for a while, so I'm not, I'm not a whale in any sense. So Coinbase is going to go public this week. It's going to be valued probably, I think it's going to end the day at about $100 billion. Apparently about 20% of the company is owned by the employees, which means there's going to be about $20 billion that are going to flow into some regular people's pockets. not banks and institutions. When this last happened with some of these kind of IPOs for internet stuff that were huge, they spawned who knows how many more companies. So this next week, you're about to see a huge influx of capital into the crypto space. Huge. And this is where I still haven't told you about proof of stake. So proof of work, right? You have to guess this number. You got to do all this stuff to earn the right to mine the next block. Proof of stake flips that on its head and says, you know what? Let's not make this so difficult. How about everybody who's got some stuff, if you could lock it up, I promise you're not going to do anything for a little while. We'll pick between all of you people who have this stuff, and you can mine the next transaction. And then what happens here, because all you're trying to do is build consensus, right? You want to disincentivize people from trying to steal the network with bad transactions. So you want everybody to get along. That's the whole point of this, is to how do we get people to get along? The proof of work makes them get along, because they can't get along unless they have it, but you have to do all that damn work to get there. Finding those correct nonces and the hashes is super hard, but checking them is easy, because it's once you have the right answer, it works, right? The lock unlocks with the key. With the proof of stake, you don't have to do all that stuff. You still, though, get that same proof, that same desire for consensus by slashing. And you if anybody gets out of line, right? Because what you're doing is, who gets to get the next block? All right, who has stuff? Okay, you have 20%, you have 10%, you have 5%. All right, at that distribution, you will get this next block and the ability to create the next block. If you screw it up, we're cutting you, and you don't get that chance, right? So now it's not who can do the most guesses the fastest who gets the right to build the next block, but it's who can consistently just mine blocks and do their damn job. And whoever can do that the most consistently, you get the next one, right? And so that need to get along, that desire to work within the system, now still exists without having to force it. And you then can secure the network using these proof of stake algorithms, and you don't have to do all this work. Now nodes don't take supercomputers to run. You can run a node on a tablet, and you can validate anywhere, right? And this opens up, that changes those transaction fees to be minimal, and changes those gas costs now to be minimal. And you don't have to work so hard to mine a block. This is why Ethereum gas fees are so high, because you have to work so hard to do a block, to do anything, to make that next, oh, you have this smart contract that says this needs to happen. Well, in order for that to happen, I have to mine a block. So I've got to, I have to build in those fees to get anything done. And by taking this whole thing and flipping it on its head, you see a new way to do it. This is where I'll get to the only time I'm going to do any kind of shilling at all during this whole thing, which is why this is not your normal cryptocurrency web show. I think I'm invested in it, and I'm really excited about the Gravity DEX that's going to be coming later. This is built off the Cosmos hub with the Tendermint core. These are some of the people doing some of the really coolest work around there, and they've been going a little bit slower than some of the other stuff, but they've been doing it right. And a lot of the people who've been blowing up have been using their stuff, because it's open source and because it's out there, to build upon, which is great. This is the idea of the Internet of blockchains, which at this point is still a bit of a marketing idea. But there are people working to take all of this stuff to the next level. And where we're at now is still just kind of a ground floor. We're starting to see what can be built here and how it's going to work. You're starting to see, how the gas and the transaction costs and the various other stakeholders start to affect things. So that's about it for the show tonight. I just wanted to talk about a whole bunch of this stuff. One of the things to remember about transaction costs and fees like that, that's always been a part of all this stuff, right? And it's the efficiency of those kind of networks that really help define a more modern society, I think, right? Because, so I as an example, right, you can't quite see it now, but I have a large Magic collection, Magic Gathering. I sell a lot of cards now because I've been collecting for a long time. And it's the same kind of thing. Each one of those is a real-world NFT, non-fungible token. And, people buy them and I sell them. And when I sell them, right, there's a transaction cost. And there's, a listing fee. There's, a time delay. All of these things exist in any transaction that you're going to ask. You're going to have to pay somebody to do it. You're going to have to pay something or someone to take it there, right? You have a gas fee for Magic cards, to ship Magic cards. So when people talk about some of these stuffs and they complain about these fees that exist in the crypto world, you have to understand these are not downsides to it, but in fact, aspects of a real live thing. It has these shadows. It has these bad things because it's real, right? If real things have shadows, real living things make poop. And so you have to understand that these aren't fatal aspects of it, but in fact, indications that what you're dealing with is a real thing. And this decentralized finance world is real and pretty fun to watch. Because of the gas fees right now, I can't really recommend anyone do a whole lot of this stuff unless you know exactly what you're doing. The returns are real, but the fees are real. And if you don't figure out that, if this doesn't stay stable for 2 years, I'm not going to get my gas fees back at the level that I'm investing, then, do the math, because those fees will eat you up so fast and your whole ether pile will disappear. And then you'll wonder, wait a second, I thought I bought a bunch of super expensive ether. And yeah, you did. And then you spent it to do nothing. And that can happen. And so the only thing I'll get even closest to for advice is, keep doing the DCA in a centralized exchange unless you feel comfortable moving outside of that. And that moving outside of it is knowledge, right? Until you feel comfortable starting to send your crypto to an address and you know that you have the right address and you know it's going the right place and you know how to watch it go. Again, because these are permissionless systems, everybody can see the transactions and you can watch as your transactions move through. And there's, all of this stuff is accessible to the world. And because you can see it, so can anyone else. And there's a weird kind of, people think some of this stuff is anonymous or pseudo-anonymous. If someone knows who the address owner is, then they know who has control over whatever is happening on that address. And they know that everything that address is doing. So just FYI, it's all there. That's part of the whole point of it. This is an immutable, unchangeable public ledger. And it's really getting exciting. So with that, I'm going to stop. And I will wish you good evening. Thanks for hanging out. Those of you who drop by, check it out later. Always fun. And good night.